Business ownership complicates divorce because it takes a lot of extra work. It also complicates divorce because oftentimes a divorce will tank a business, and we want to prevent that from happening. So, if we can settle things, we need to settle things. If we can keep things quiet, we need to keep things quiet. But the reason it complicates things is because, generally speaking, if it is a larger business, you have employees, you have assets, if you have goodwill, we need to put a value on those things. And so in doing that, we've already complicated it because we're going to need to bring in a forensic accountant, or we're going to need to sell this business on the open market. Most people don't work their whole lives to build a business to just sell it away in a divorce. So you're going to want to keep it. So we're going to need to value it. We're going to need to figure out the buyout terms for that. Can we trade a house? Can we trade pensions? The other thing that we're going to need to look at the business is a cash flow analysis. It is the American way. There's nothing more American than avoiding taxes. However, that's not going to save you when the other spouse comes and says, you know what? I need a cash flow analysis because I know my spouse and he runs our cars, our mortgage payment, all of our food, everything else through this. And so what they're going to have to do is a cash flow analysis to figure out how much money do you actually have available for support. And so anytime you bring in extra experts, it's going to cost money. The other additional part that runs up money is in discovery against the business. What business records are discoverable? Sure, you're going to have to give them your profit and loss, your general ledger. Can they get down to your client information? Do we need a confidentiality agreement? Do we need a protective order, making sure that those documents don't get out? And lastly, there is an issue of one spouse trying to cut and run, taking client lists, taking specific knowledge of the business, and opening up a competitor. All of these things are rife for litigation and run up the costs of a divorce. All right, so for the valuation of a business, the simplest one, we can all agree what the value is. You can have your bookkeeper come up with one. Most people aren't going to agree to that. Generally speaking, what we're going to do is we're going to get an expert. Now, we can get what's called in California an evidence code 730 evaluator, which is basically hired by the court and both parties to be their evaluator to determine, well, what is this business worth? And we have a couple different cases and methods that we look at. I'm not going to bother you with that. But that forensic accountant is going to have to come up with a value. Now, if one of the parties doesn't agree with that value, then they're going to hire what's called an evidence code 733 evaluator, which is an expert that is going to basically say why that original evaluator's opinion was wrong. Lastly, and a thing I generally like, I think it's oftentimes lazy to get a joint evaluator or a joint forensic accountant to figure out the business value, is you hire your own accountant that you can work with and that you can work with in helping to understand and control the numbers. Sometimes an evaluator will come up with a price, and it's good to challenge them and say, all right, well, if I put this on the open market, what would this business be worth? Because a lot of times they'll say a business is worth $1 million. Well, all right, if we could find someone to buy it at $1 million, then I'd agree. The easiest way to determine the value of any asset is what it's worth on the open market. But generally speaking, when we talk business valuation, we're talking about a forensic accountant, hopefully the one that understands the industry and that will place a value on that business. The role of prenuptial agreements in protecting a business asset is that they basically dictate the rules about how things were divided. So generally speaking, we're talking about a person that either wants to start a business or has started a business prior to marriage. And they're going to agree prior to the marriage that, hey, this business is my separate property, is going to remain my separate property. And the other spouse will take no interest in this. And as a part of that, we fully disclose this is the value. These are the things that this business has. And hey, new spouse, you're not going to gain an interest. Now, remember, if you don't have a prenup, we fall back to community property law, which says that all income derived from your skill, your labor, your knowledge during marriage is community property, just as well as any compensation coming in from your skill and labor from an employer or from stock increase in the business. All of that will be community property. The value of the increase of the business during marriage, absent a prenup, is community property. And so you can have a separate property business that has large portions of community property if you don't have a prenup. So again, the prenup limits the liability of the business to community property. Think of community property and community income as a virus. It infects everything, all the separate property it goes into. By having a solid prenup, we can make sure that the community does not gain an interest in the business by operation of law. So again, a prenup creates the rules about how assets are distributed post-separation. So business debt, if it is separate property, business debt remains its own separate property. So say in a prenup, your business debt would remain separate property debt. However, if it is acquired during marriage, if the liability or the debt is acquired during marriage or accrues during marriage, then it is community property. And so both spouses are going to be liable. First, the court would look to the assets of the business to figure that out. But if we have additional debts afterwards, then yes, both parties are on the hook for that debt. Again, always just look at if an asset or a debt is acquired during marriage, then it's presumed to be a community property asset or debt. And so if you want to make an argument to the contrary, you're going to have to provide evidence to flip that. If you're a business owner and you're facing divorce, please call Real Fathers Rights. We will try to get it done as simply as possible. And if we can't do it simply, and if we can't do it quietly, then we will litigate and we will make sure that your business and your interests are protected.